Hey everybody, this is AJ from Optioneer. We've had a pretty wild ride on the SLV side of the house. It's obviously the ETF I trade most frequently. It's something I really enjoy getting into. I had one of my traders ask me how I was handling maybe the incredible run up we've had over the last few months, as well as the volatility we've had just in the last couple of weeks. So last Friday we had a 30% ish drop. And then today, which is Thursday, February 5th, we had another pretty big 15% drop. So for somebody that trades the way that I do, those big drops are a pretty good opportunity as a long term owner of this ETF. Obviously, none of this is financial advice, but I just put this out there for the community to share. So what I have uh, up on the screen is a strategy. It's really a covered call strategy. Obviously, I have this long position that's being excluded right now, just so we can understand what's happening with this call. So I had previously sold this call. I believe I sold this one back in early December for a June 18th expiration. I usually like to sell them a little bit shorter in time. I'd end up pushing out maybe a little bit too far in time to get that strike price up a little bit so I could capture a little bit more profit. Just to see what this looks like if you include the long position, the underlying of the covered call, which is what a covered call is. This shows really my profit loss curve here. So I have maxed myself out at about $4,000 for this position if I stay at this 51.5 strike price on the call. So if when I take this out, you can see that individually I'm getting really close to that break even number. For the option position itself. So here's what I did today. So I had originally sold this for $16.17. Obviously, it's times 100 because option contracts happen in hundreds. I had to buy this back for 1935, so 1935 ish plus commission. That for the option position gives me a little bit of a realized loss here of about $295. So I buy this thing back. The debit that it cost me was 1935. The loss is only $300 because I had originally made this $1,600 selling it. And so with that understanding, I rolled this up another 150 bucks. So from a 51.5 to a 53 call. So I sold this one at $16. So I had a 1935 debit. I took in by selling this call at a higher price, a $1,600 in credit. And then I sold this put position, which is actually higher. So makes it really a more advanced move here. We would call this like inverting because my put is at a higher position than my call position. You would only want to do this, in my mind, when you're already very underwater in that call position, because that underwater call gives you a little bit of a hedge there. So I'm able to sell this one for $345. And then that puts me at a net credit of 1945. So remember, I paid 1935 on the other side. I end up making 1945 on this side, a 10 credit positive. So it follows my ABCs, right? Always be collecting credits. And obviously, that's not a huge profit. But if you include the underlying and the effect that that's going to have, that then pushes me up to about 400 and $4,487 of total profit that I can make. This isn't the last move I'm going to make before this happens. Now I'm also pushing back that that expiration date from June all the way back over to March. So that's going to give me a lot more theta, right? Because I'm moving back in time. It's going to give me more of that decay. So, one of the questions that I get a lot is like, how are you able to keep track of all these, one transaction after another? If you always, if you follow the ABCs, right, always be collecting credits, you will end up ahead in the end. That's not a guarantee for investments. That's just a mathematical truth that if you're always collecting more money and you are covered, you are going to end up ahead. That being said, that's probably not good enough for most of the more fastidious folks. So I have this option tracking spreadsheet that I built a while ago here, and this is actually incorrect. So this was what was it, March 20th, right? So what we ended up putting here. So that's going to be 320. So what I do is I end up filling in these positions and keeping track of them that way in a more static fashion. It ends up being slightly more manual, but if you do it for a year, it's actually pretty incredible what you can see happening. I only have a couple here that I've been trading so far for this 100 shares in this year. I had this put that I had sold for 103. I bought it back for 2360. I sold this other put at 376 and then bought that one back for 35 bucks. And then I'm able to keep track of all of the profits over here. Now you see this $300 is essentially what I lost on this position. So I opened this up in the end of December. I made $1,600. I ended up buying it back for $1,900. So that is a net loser for me. But you are able to now take all of these profit and loss and you see like a total gain for this underlying. I found it to be maybe the best way to track. I call them like underlying campaigns. And if you subscribe and you send me a note, I can send this to you for free. Just if you want to use it or have any questions. That's really it. Today's going to be a pretty short one. I just wanted to do this. I call it the SLV roll call. All right, everybody, have a great rest of your day.